And here's a big story on India tonight. After suffering one of their worst days of trade since June yesterday, US stocks are looking to recover. All three major US indices have opened quite flat but are trading marginally in the green now. US stocks have reacted to their European counterparts, the major European indices having ticked downwards because investors have kept that eye on rising fuel prices. Also, benchmark gas prices in the European Union have spiked around 13% overnight. The euro, on the other hand, has gone down to its 20-year low. Of course, all eyes are now on the Jackson Hole symposium that takes place later this week. What's the commentary going to be like? The chair of the US Fed Reserve, Jerome Powell, is going to brief the nation on the state of the US economy. And analysts are predicting that the central bank's commentary will most likely remain aggressive towards controlling rising inflation, even at the back of the risk of an American recession. So let's break this down. What's likely to happen next with the American economy, with the Fed's interest rate action, and what could be the fallout for emerging markets like India? To do this, I have a great panel with us. Peter Cardillo is Chief Market Economist at Spartan Capital Securities. David Madden is also joining us. He's a market analyst at Equiti Capital. And Anurag Singh is managing partner at Ansid Capital. Great to have you with us, gentlemen. David Madden, to you first. Now, though the Fed has taken that unprecedented step of hiking 3/4 of a point at successive meetings, David, markets had been in rally mode despite it. And that was perhaps based on hopes that the central bank may soften its pace of rate increases heading into the fall. But it doesn't seem like it after the minutes of the meeting came out. I mean, look at how the Dow Jones has performed since the recent bottom it hit in mid-June. It's up more than 14%. And now, of course, the summer rally could have fizzled out. Fears of aggressive interest rate hikes have returned to Wall Street. But how do you expect the American markets to move from now into the fall and through to the end of the year? David.
I'm sorry, I'm having a bit of technical issue. Would you mind repeating the question, please?
David, I was talking about how the Fed has moved so far and how the markets have responded. As far as the markets go, we have seen that slump coming in mid-June, but they've done all right. I mean, the Dow Jones has done well for itself for the most part. In terms of the action taken by the Fed, in terms of expectations of the Fed, Jerome Powell, in his commentary and their aggressive rate action likely to continue, how are the markets likely to perform now going into the fall and perhaps till the end of the year? What's your reading?
I think it all comes down to what goes on with the US government bonds, and particularly the 10-year yield. Whenever we see the 10-year yield above 3%, that's usually the point we see a sharp sell-off in stock markets. And I know you mentioned about how the Dow Jones and the S&P 500 and the likes enjoyed a decent rally in late July and for much of August. But that was all at a time when the US 10-year yield was well below 3%. In many cases, it was below 2.9%, or even from time to time, it was actually below 2.8%. Now things are kind of ratcheting up again. And now that we've seen in the last 24 hours a break above the 3% level, I think that's going to really kind of focus minds. And given the fact that yields are pushing higher, it would indicate the bond trader thinking we're going to see more large rate hikes from the Federal Reserve in the months ahead. I wouldn't be surprised if you see a turning over in US stocks. Look at today's economic indicators after all, between the housing stats, the decline of over 12%, its largest monthly fall since 2016. On top of that, the services and manufacturing reports were very disappointing, to say the least. Lowest readings in well over 2 years. And let's not forget, the United States is in a technical recession. So it was odd to see the likes of the Nasdaq 100, the S&P 500 rack up multi-month highs only in the last few days or few weeks, all the while the US is in a technical recession. So I think the Federal Reserve are going to continue on down this path of hiking rates. And I think I wouldn't be surprised if you see a rolling over in stocks.
Peter Cardillo, do weigh in on this. As far as sectors go, tech shares have been heavily beaten down. The industry is seeing so many pink slips going around too. That's one big sector that has taken it on the chin. And the fallout, of course, hits India too. It's one of our biggest exports to the States. But even beyond IT, which parts of the market do you reckon will hold out and which ones will crumble along the way with lower liquidity perhaps in the financial markets as the economy there slips into a possible recession?
Well, to begin with, I want to address the point at the upcoming Jackson Hole Symposium. I think central bankers will continue with their rhetoric of tough talk to fight inflation. Obviously, the Fed Chief Powell will certainly do that. And I think that, while that rhetoric remains tough, that we're probably headed for 2 more rate hikes before we see a pause. And that's probably a 0.5% point in September and possibly a 0.5% in November and then a pause in December. Reason being is that there is some good indication that inflation is beginning to come down. Commodity prices are extremely, have come down heavily. The price of oil is down from its peak, although it still remains a threat, especially natural gas due to the situation in Europe. But if you look at other commodities, they've come down rather sharply. And if you look at some of the structural inflation that had gone up, that too is beginning to weaken. And so I think that would be enough of ammunition for the Fed if we get, obviously, better inflation readings both in September and in November, that they will likely pause. Remember that their goal of Fed funds rate at 3.25% is not that far behind. So I don't think they have to get overly aggressive, even though the aggressive talk will continue.
Well, Anurag Singh, do come in. There is a belief that the US Fed Reserve's decision to hike interest rates would in turn put pressure on the RBI to hike India's interest rates further because there would be a natural impact on the balance of payment, and that would put pressure on our bond yields. It has already weakened the Indian rupee a lot. So do you subscribe to that understanding on how higher interest rates in the US could affect India? And if you do, how do you think the Indian economy projections, which point at an over 7% annual growth, could actually play out?
Vikram, look, first of all, I don't think RBI has much of work to do. Look, there is a context here. Indian inflation is just about at 7%, actually now below 7%. Which is very different. RBI's stated target is 4% plus minus 2%. Most of the times it never falls below 4%. It stays above just by about 2%. So if we are in the territory of 6%, given the economic backdrop in the world, I think we are good enough. And I think we have just got closer to that point. US has a very different battle to fight. The target, Fed target is 2%. And they are running at 6, 7, 8%, depending on which data you count. So that's a very different battle. I don't think beyond a point, Fed will continue to fight the battle here, although we can debate about that, how much will they kind of continue to raise the interest. But I think Indian battle more or less is done, just about 50 basis point more. And I think RBI doesn't need to hike the rates. In terms of economy, Vikram, I think the projection is 7%. I really doubt it. Look, IMF has been, they always act after the event and after the fact. So they've been kind of reducing the targets this year throughout. I think we would be happy if we can get away with 6%, given the global backdrop of such low growth and even negative growth in the rest of the world. I think even a 6% is a very healthy growth for India. And I think that's what we should hope for.
David, the minutes of the Fed's last meeting, when they approved a 0.75% rate hike, it sees these kind of interest rate hikes continuing. At least that's the large expectation, at least until inflation eases substantially. Those are their words. And that doesn't come as a surprise. But clearly the Fed seems to be inducing a recession to tackle inflation. I also believe the Fed has been removing cash from the system that was pumped into the economy when the pandemic first started and is expected to continue to do this, even if the pace of rate hikes slows down, like Peter was suggesting. Is that approach of almost inducing recession likely to help the American economic cause, or is it not sustainable in the long run?
That's to me, Vikram?
That's for David.
Okay.
I think many central bankers around the world, including the Fed, sneaking.
David, we seem to have a technical glitch. David, just hold your thought. We seem to have a technical glitch. Your audio is not coming through very well. Let me take that across to Anurag. Anurag, you want to take that?
Yeah, sure. So Vikram, look, the minutes didn't reveal anything. And because the new mantra for the Fed is ambiguity and being data-driven. Well, they've always been data-driven, but this time the clear direction from them is that we will not give any forward direction. And because, that's because in the past, historically, they've been surprised on the downside, mostly, and on the upside on inflation. I think they've really decided not to give any future indications or directions. Second is bad news in the economies is good news for the Fed and the markets. That's how the market is currently behaving. Look, I think Vikram, Fed has just about 100 basis points to go. They're at 2.25%. I think at best, it's very evident. We've seen in Fed talk that they have turned a little more dovish, even Powell in the last discussion that we heard from him. So I think they would get to around 3.25 and then stay at that point and observe. Because look, here is the issue with the Fed. Inflation might be softening, but what if it comes down at 5% and then stays persistent there? And that's a very different challenge that Fed might have to face later.
Peter, I know the Fed follows the Personal Consumption Expenditures Price Index, and that index has risen 1% in June, and that index was up 6.8% year on year. Is this index very dissimilar from the consumer price index over there, which went pretty flat in the month of July? Because it really begs the question for the correct inflation picture in the US. How are we to know whether the Fed's moves on interest rates are actually working and what they could do next? And will the pace of hikes come down or not? How do you figure this out when there is conflicting data here?
Yeah, a good question. As you know, the Fed's favorite index is the PCE. In fact, this week on Friday, we'll be getting a reading of that, and we're looking for a slight drop on a year-to-year basis, which would confirm the CPI numbers that we got just a few weeks ago. So, it's a combination of factors. And this time around, things are a little bit different than in normal times because not only do we have high inflation, we have the risk factor of the war. And of course, we had inflation mostly due to the coronavirus lockdowns, which created massive supply shortages, and with the Fed continuing to pump money into the economy, things got out of hand. So it's a little bit different this time around as per normal times. And I think, like I said before, if we begin to see inflation data come in, obviously we're not looking anytime soon to see inflation to reach the Fed targets. That's out of the question.
Right.
I think that's going to be at least a year and a half to 2 years away.
Right.
We might wind up with 3 or 4%. And if you have rates around those levels or slightly lower, the economy can do well.
Fair enough. And the commentary is going to be very keenly watched and heard as soon as it comes out. And perhaps we'll reconnect with you, gentlemen, and get further insights. But David Madden, sorry we couldn't get a clearer line with you. Anurag Singh and Peter Cardillo, thank you, gentlemen, for your insight and perspective on American inflation, on Fed action, and the fallout on emerging economies like India's.